Today, buckle up, 2023's bumpy ride ahead. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and problem news with a distinctively Australian flavour. Well, at the end of the year, we can look back and pick over the coals of the old and look ahead to the new, but of course it's an artificial delineation. And the forces mustering at the end of the old year, such as recession risk, rising interest rates in response to inflation, Ukraine, and COVID, are all still in play. So remember, US stocks just polished off their worst year since 2008 with a loss on Friday, bringing the year-to-date decline for the S&P 500 to 19.4%, its largest calendar year drop since 2008. The only years when stocks failed worse were 2002, 1974 and 2008. The same holds true for the Dow Jones Industrial Average, which shed 8.8% this year, and the Nasdaq Composite, which lost 33.1%. As previously high-flying megacap technology stocks and other interest rate-sensitive assets crumbled, value stocks outperformed this year, sending the Dow to its biggest calendar year outperformance versus the Nasdaq since 2000. The blue chip gauge also recorded its biggest outperformance versus the S&P 500 since the indice's creation. Energy stocks were a lone bright spot, as the S&P 500 energy sector recorded its best year on record with a 59% gain, the war effect. The dollar extended declines against most major peers, but made a gain of 8% in 2022. That's the biggest annual percentage increase since 2015, but it also lost more than 7% this quarter for its biggest quarterly percentage decline since the third quarter of 2010, as some investors bet the Fed may slow rate hikes. The dollar index fell 0.173%, with the euro up 0.12%, and the Japanese yen strengthened 0.86% to 131.87 per dollar, even after the Bank of Japan unveiled an unprecedented third day of unscheduled bond purchases, while sterling was last trading at $1.20, down 0.18% on the day. Losses this week scuppered hopes for a rally to close out 2022, a year when inflation reasserted itself to wipe a fifth in value from global stocks, the worst run since the financial crisis. Bonds lost 16% of value, the biggest decline since at least 1990 from one leading measure, as central banks raced to slow rising consumer prices by hiking interest rates around the world. We've never seen a market environment like this, where both stocks and bonds were down simultaneously, said Art Hogan, Chief Market Strategist at B. Riley Wealth. The good news is that we will soon put the year in the rearview mirror. The bad news is that 2023 could be a bumpy ride, at least for the first few months. Weaker economic trends will likely form heading into 2023 as the Fed battles inflation, but a mild recession may help set stocks up for a better second half of the year, he said. After a banner year for stocks in 2021 that saw the S&P 500 climb to consecutive record highs, not many foresaw the sell-off that ensued, though I went to cash a year ago. But after rising to yet another all-time high on January the 3rd, fortunes quickly turned as the Federal Reserve signalled determination to rein in inflation. That foreshadowed the onset of the most aggressive rate hike path in decades, leaving stocks and bonds tumbling in its wake. With US stocks dragged into a bear market, the drop in treasuries sent benchmark 10-year yields to 3.9% from 1.5% at the start of the year. That could present a difficult outlook for fixed income in 2023 and a revival of the widely followed 60-40 portfolio that got hammered in 2022. So all this closed out the worst year in more than a decade for both global equities and bonds. Treasuries fell, sending yields higher across the board. The US 10-year Treasury yield rose on the day and closed out the trading year with its biggest annual increase in decades, pushed higher by aggressive Fed rate hikes. Benchmark 10-year notes were up 4.7 basis points to 3.882%, while the 2-year note was last up 6.3 basis points to 4.4299%. Bond investors bid a not-so-fond farewell to 2022 as they look forward to a much more attractive 2023, said Bryce Doty, Senior Portfolio Manager at SIT Fixed Asset Advisors in Minneapolis. While stocks will struggle with slowing economic activity and the loss of inflated earnings from inflation, bonds are earning a decent income with the potential for price appreciation as yields come off their peak, he said. The Fed is nearly done raising rates. We expect no raise at the Fed's May meeting and inflation is slowing, he said. Concern about the spread of COVID-19 that surfaced this week still weighs on the market, though. The European Commission has asked EU member states to review COVID testing and sequencing procedures amid increased concern about the virus spreading from China. Elsewhere, emerging market stocks were set for the first weekly advance in 3, though the benchmark index remains on track for a decline of more than 20% in 2022. Oil dipped, adding to a 3-day run of declines on worries about a rise in crude stockpiles and concerns that rising COVID-19 infections in China would slow demand in one of the world's top oil importers. US crude recently rose 0.4% to 78.71 per barrel, and Brent was at 83.96. Gold was barely higher on Friday, but looked likely to wrap up its biggest quarterly gain since June 2020, after the Fed's fast-paced tightening cycle had tempered bullion's progress for the year. US gold futures gained 0.15% to 1,822. Bitcoin is ending the year limply, slipping around 0.8%, having brought its decline in 2022 to more than 64%. Now, some have taken umbrage to recent comments that Mark Cuban has made about gold as he champions Bitcoin, perhaps none more than Peter Schiff. In an appearance on comedian Bill Maher's Club Random podcast that aired on December the 25th, Cuban offered his unfiltered view of gold versus Bitcoin. If you have gold, you're as dumb as, the billionaire investor said to Maher. The owner of the NBA's Dallas Mavericks added, "It's not a hedge against anything. What it is a store of value. Gold is a store of value, and so is Bitcoin," he said. And he also said he'd be interested in adding to his Bitcoin holdings as its price decreases further. Of course, the assets are down more than 64% so far in 2022, while gold is off by less than 1% to date, as at the end of last week. "I want Bitcoin to go down a lot further so I can buy some more," Cuban said. He said owning physical gold is impractical in a digital world. And Cuban's comments apparently raised the ire of Peter Schiff, a longtime gold advocate and investor. His lack of understanding of Bitcoin is only exceeded by his lack of understanding of gold, Schiff wrote on Twitter. Cuban, in the podcast, said he wasn't advocating for anyone to buy Bitcoin, but thinks that the digital asset has more benefits than the precious metal, which he also views as a digital transaction. Now, the MSCI's World Equity Index was down around 0.57% on the day, and that's a 20% annual fall, its largest since the global financial crisis of 2008, when, by the way, it slid more than 43%. The European Central Bank eased the pace of its interest rate increases earlier this month, but stressed significant tightening remained ahead and laid out plans to drain cash from the financial system. This is the beginning of a new era when central banks will be playing a more subdued role in the markets, with less liquidity available to fix problems, a more than necessary move that came perhaps too late and too painfully, said a senior analyst at Swiss Quote Bank. Given that there is still plenty of cheap central bank liquidity waiting to be pulled back, the situation may not get better before it gets worse in the first quarter of next year. European shares slipped on the last trading day of a rough year, marked by geopolitical tensions and fears of a recession as central banks hiked rates, while London stocks outperformed their counterparts on the continent due to heavy commodity exposure. The Stoxx 600 index fell 1.3% in thin trading on Friday as surging COVID-19 cases in China stoked concerns over global economic growth. The Pan-European index fell 12.9% for the year. That's its worst performance since 2018. China luxury-exposed firms such as LVMH and Hermes International declined 2.4% and 2.7% respectively. And of course, this year the United Kingdom saw the death of its longest-reigning monarch in 2022 and 3 prime ministers occupying Downing Street in the second half of the year amid a worsening cost of living crisis that sparked strikes and protests across Europe. The FTSE closed down 0.8% in half-day trading on Friday. German stocks clocked a yearly fall of 12.3%. That's the worst performance since 2018, though on an upbeat note, data showed that Spanish December consumer prices rose just 5.8%, their slowest annual pace this year, thanks to lower electricity prices compared to a year ago. And Telecom Italia fell 3.8% after Prime Minister Giorgia Meloni on Thursday reiterated that the government wanted to take control of the former phone monopolies' fixed network assets and safeguard employment levels. China's health system has been under stress due to soaring cases since the country started dismantling its zero-COVID policy at the start of the month, with Spain and Malaysia on Friday joining countries imposing or considering imposing curbs on travellers from China. Chinese leaders have pledged to set up policy adjustments to cushion the impact of surging infections on businesses and consumers. Now, here in Australia, shares finished the final session of the year in the green, sealing an annual loss of 5.5% for the benchmark. Of course, we did not run up as hard as the US the previous year. The S&P ASX 200 rallied 0.3% to 7,038, and on Thursday, shares closed at a 7-week low. Afterpay parent Block added 4.1% to 91.94, and Woodside Energy added 0.9% to 35.44, and BHP Group fell 0.4% to 45.63. Link shares traded for the first time without the right to receive the PEXA in specie distribution, showing a 40% decline to $1.97. Link shareholders approved the transaction on December the 23rd, whereby they received 1 PEXA share for every 7.52 Link shares held. PEXA rose 0.5% to $11.95. Warrego Energy issued its target statement amid competing bids from Hancock Energy at 28 cents a share in cash and Strike Energy at 1 new Strike share per Warrego share. The majority of Warrego board recommends the Hancock offer in the absence of a better deal, but the recommendation is not unanimous. Chairman Greg Columbus rejects the Hancock offer and recommends the Strike deal. Warrego was flat at 31 cents. Strike issued a supplementary bidder's statement indicating that shareholders controlling 20.5% of Warrego support Strike's offer, including the chairman's declared interest. So, more broadly, what is ahead for next year? Well, fears that efforts by the Federal Reserve and other major central banks to bring down a surge in inflation will spark a major economic slowdown. And that has really moved front and centre as the calendar flips into 2023. We might see one of 3 scenarios: a shallow and brief recession, or a swamp recession, or perhaps no recession, or maybe just a small technical recession. In Australia, some still believe we will avoid a recession thanks to massive inward migration, though probably a recession per capita is on the cards. Now, a shallow and brief recession is possible because the economy has enough inertia to grow slowly at least through the first half of 2023. To be sure, a severe recession would be bearish for stocks, yet given the resilience of the US economy and the tight labour market, they are expecting a slowdown or shallow and brief recession. This could then allow stocks to rally in the second half of 2023 after a volatile first quarter as they look around the recession corner, and the current market consensus perhaps is too pessimistic on this view because the consumer still has bandwidth and spending will hold up better than the naysayers predict in the tight labour market. US employers hired more workers than expected in November and raised wages, shrugging off most worries about a recession. The November jobs report showed the economy gained 263,000 jobs last month, topping Wall Street's expectations, with the unemployment rate holding steady at 3.7%, remaining close to a century-half low. However, job growth is expected to slow in 2023 as higher interest rates crimp investment and as more industries fully recover their pandemic headcount. But, according to Julia Pollack, chief economist at ZipRecruiter, this kind of substantial cooling in labour market conditions will be far from recessionary. The Congressional Budget Office's estimates show that the number of employed Americans will rise from 158 million in 2022 to 174 million in 2052. Pollack said the economy should be comfortable even with lower numbers of job gains in subsequent years. Those projections imply net job gains of only 45,000 jobs a month on average over the next 30 years, absent an increase in US population growth. Mark Lucini, chief investment strategist at January Montgomery Scott, thinks the stock market is likely to bottom ahead of the actual beginning of the recession, with an anticipation of the eventual recovery. On the other side of it, we expect stocks to struggle and continue under pressure over the coming months or a quarter or two before ultimately establishing a more sustainable advance, perhaps in the second half of next year, he said. And he attributed the economic resilience to the healthy balance sheets of individuals and households which accumulated abundance of savings during the pandemic. But there is also the risk of a swamp recession, where forecasters think a recession in 2023 will be mild and brief and will be followed by a strong economic recovery. But one JP Morgan strategist says the economy will struggle to get out of it. David Kelly, chief global strategist at JP Morgan Asset Management, argues that rather than falling off an economic cliff, such a recession will be more like sliding into an economic swamp, meaning it will be hard for the economy to bounce out of it. The good news is that a prolonged period of economic swampiness should snuff out inflation and force the Federal Reserve to reverse a significant part of their 2022 monetary tightening, wrote Kelly in a note back in November. However, the flip side is that a mild recession would likely not create much additional pent-up demand, and assuming we see only a modest increase in unemployment, the employment and income boost from a falling unemployment rate would also be less than normal, he said. Perhaps most significantly, in contrast to each of the last 4 recessions, there is unlikely to be any significant fiscal stimulus to re-energize the economy. Wall Street analysts have warned stock market investors that they should not expect any form of a Fed put next year. No recession, or a small technical recession, is what others believe, like economists at Goldman Sachs, who have doubled down on their call that the US economy will probably achieve a soft landing, meaning the central bank could tame inflation without stunting economic growth. And they also expect the economy to narrowly avoid a recession as inflation fades and unemployment nudges up slightly. Our economists say there's a 35% probability that the US tips into recession over the next year, an estimate that's well below the median of 65% among forecasters in a Wall Street Journal survey, said Goldman Sachs. The US may avoid a downturn in part because data on economic activity is nowhere close to recessionary. After 2 consecutive quarters of negative gross domestic product, that's GDP growth, of course, in early 2022, the US economy expanded in the third quarter, growing at an annual pace of 2.9%, according to government data. Consecutive quarters of contracting GDP are often described as a technical recession, although the National Bureau of Economic Research, which serves as an arbiter of the business cycle, has a much broader definition of recession. And there may be more tech contractions, of course, and China's COVID-19 issues may surge. And above all, there is no central bank riding to the rescue if things go wrong. Reeling from a record $26.5 trillion wipeout, global stocks must surmount all those hurdles and more if they are to escape a second straight year in the red. And bulls looking ahead to 2023 might take solace from the fact that 2 consecutive down years are rare for major equity markets. The S&P 500 index has fallen for 2 straight years on just 4 occasions since 1928. But the scary thing is that when they do occur, drops in the second year tend to be deeper than in the first. Now, here are some facts that could determine how 2023 shapes up for global equity markets. Optimists may point out that the rate hiking peak is on the horizon, possibly in March, with money markets expecting the Fed to switch into rate-cutting mode by the end of 2023. A recent survey showed 71% of top global investors expecting equities to rise in 2023. Vincent Mortimer, Chief Investment Officer at Europe's largest money manager, recommends defensive positioning for investors going into the new year. He expects a bumpy ride into 2023, but reckons a Fed pivot in the first part of the year could trigger interesting entry points. But after a year that blindsided the investment community's best and brightest, many are bracing for further reversals. One risk is that inflation stays too high for policymakers' comfort and rate cuts do not materialise. A recent model showed a 100% probability of a recession starting by August, yet it looks unlikely central banks will rush in with policy easing when faced with cracks in the economy, a strategy they deployed repeatedly in the past decade and helped to create inflation in the process. Policymakers, at least in Eastern Europe, now appear resigned to weaker economic growth in 2023. Deutsche Bank's Global Chief Investment Officer Christian Nodling told clients in the note, recessions might be short, but will not be painless, he warned. A big unknown is how tech megacaps fare following that 35% slump in the Nasdaq in 2022. Companies such as Meta Platforms and Tesla have shed some 2/3 of their value, while losses at Amazon and Netflix nearly exceeded 50%. Expensively valued tech stocks do suffer more when interest rates rise, but other trends that supported tech's advance in recent years may also go into reverse. Economic recession risks hitting iPhone demand, and a slump in online advertising could be a drag on Meta and Alphabet. In Bloomberg's annual survey, only about half the respondents said they would buy the sector selectively. Some of the tech names will come back, as they have done a great job convincing customers to use them, like Amazon, but others will probably never reach that peak as people have moved on. Kim Forrest, Chief Investment Officer at Boca Capital Markets, told Bloomberg. Previously resilient corporate profits are widely expected to crumble in 2023 as pressure builds on margins and consumer demand weakens. The final chapter to this bear market is all about the path of earnings estimates, which are far too high, according to Morgan Stanley's Mike Wilson, a Wall Street bear who predicts earnings of $180 per share in the S&P 500 versus $231 previously expected. The upcoming earnings recession might rival 2008, and markets are yet to price it in, he said. Beijing's early December decision to dismantle stringent COVID-19 curbs seemed like a turning point for the MSCI's China index, whose 24% drop was a major contributor to global equity market losses in 2022. But a month-long rally in mainland and Hong Kong shares has petered out as a surge in COVID-19 infections threatens economic recovery, and many nations are now demanding COVID-19 testing for travellers from China, and negative for global travel, leisure, and luxury stocks. Technicals are increasingly driving day-to-day equity moves, with the S&P 500 whistling below average stock turnover in 2022, but explosive growth in short-term options trading. Professional traders and algorithmic-powered institutions have piled into such options, which were until recently dominated by small-time investors. That can make for bumpier markets, causing sudden volatility outbreaks, such as the big intraday swings after October's hot US inflation print. And also, with the S&P 500 failing to break out of its 2022 downtrend, short-term speculation remains skewed to the downside. But should the market turn, it will add fuel to the rebound. And what of crypto? Well, of course, regulating crypto will be top of the mind in 2023. Congress will have to come to a conclusion first on how to classify crypto as either a commodity or a security to achieve a clearer regulatory framework for the asset class. To be sure, there's the question, of course, as to whether crypto should be regulated at all, especially in the wake of a string of scandals, including Sam Bankman-Fried's FTX. In any case, there's a barrage of proposals on the table, including from Democratic Senator Elizabeth Warren, as well as one sponsored by Debbie Stabenow, a Michigan Democrat, and John Boozman, a Republican from Arkansas. and there's also one backed by Senator Cynthia Lummis, a Wyoming Republican and crypto advocate, and Kirsten Gillibrand, a New York Democrat. We'll see what bills, if any, get traction in the coming year. And what's the outlook for Bitcoin? Well, that remains the same as ever, but some are proffering estimates, like Yves Lamoureux, the president of macroeconomic research firm Lamoureux & Co., says he sees Bitcoin dropping possibly to around 13,000 US, and then taking another run higher as the dust settles from the recent run of scandals in the industry. He sees real momentum for Bitcoin taking hold in 2025 when mass adoption of owning it propels the digital asset higher. And Ryan Selkis, the founder and CEO of Mustering, a crypto analytics firm, says that Bitcoin, quote, is beginning to act more like a credible neutral reserve asset. Based on some measures comparing Bitcoin to gold, Selkis estimates that Bitcoin, well, could be worth $500,000, but then offers no time frame for such a rise. But my closing thought is this: 2023 might just be worse than 2022 from a market perspective, so prepare for a bumpy ride and spread your risks. Oh, and of course, Happy New Year. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.